and gentlemen, K-Kim here with the Traders Club. Welcome to the market update. Hope you guys are enjoying your weekend, and hope you guys are been trading well here. Last couple weeks, I was gone last weekend. I was traveling. I'm back. I had a couple things to take care of this over the weekend, Friday and Saturday. So doing this video on Sunday. Today's Sunday afternoon time. So let's continue with our analysis here. Let's start with Spider, Diamond, Qs, the Russell, Semi, and the banks, and we'll finish this video through after those names there. And I haven't really changed. Let's start with Spider here, but I haven't really changed anything on my chart here. So let's do a little bit of maintenance. Obviously, we've been talking about that level here. That is that kind of a prior resistance. This is a short-term resistance potentially acting as support. And once again, what happened was though, really, let's zoom in here. You can see we got above all-time high. This was all-time high level at 293. So I'm actually going to get rid of that, knowing that we've kind of cleared above it. And then we pull back initially. And after we pull back, we started at 20 MA. Right, we talked about that 20 MA on the last video, I believe, that 20 MA, and that is a level that is coinciding this rising uptrend support and then this rising pivot. So we got that rising pivot, we got that rising support, we got that rising 20 EMA. This is a kind of light bluish, greenish moving average there, and at the same time, this is a gap, right? Yep, that's a gap. Go to hourly, then you can see that there's a gap there. You see that's a gap because that gap's still open, right? So that's that area, right? So this is that area, that right here. That's the gap here. So you know what I'm gonna do? I'm actually gonna annotate that. I mean, it's a small gap, but that's the kind of area we saw bounce on Thursday, right? That's a Thursday. Dip buyers came in, brought this back up, and this is a Friday. We gapped up, initially came down, closed the gap, and again, when the gap gets closed, what happens is it becomes instant support, and then we got up here. So right now, this is kind of how the chart looks like. So we got the rising support, the pivot, the support, the 20 MA, and that little gap area coinciding with that 20 MA area. We got a little bit of Morningstar reversal there. We got that red candle. We got like doji type of candle, and then gap up move. So we got the 3-day Morningstar reversal type of candle pattern there. So again, we want to continue to give benefit of the doubt to the buyers because trend is up, and a lot of these moves is actually mostly psychological. And if you've been following me and been watching my videos over the months, and we talked about this, right? I mean, this move is irritating. Not only is it irritating how a lot of the bears, but it is irritating the majority of participants because majority of participants is not participating to this recent run-up, and they did not anticipate that the market is going to be at all-time high 4 months later. I mean, like just think about how fast the sentiment shifted. I mean, how to extreme bullish sentiment where like 90% of market participants are thinking, okay, well, the whole market is probably getting into a recession, some kind of a bear market or some steep crash, to, oh, well, we're at all-time high now 4 months later. And this is total dumbfounded moment, right? And so why is the market keeps on grinding higher like this? Because majority of retail traders are not in it. They're not in it. And a lot of hedge funds are not in it. They're underperforming. Like, remember, most people, I mean, a lot of people are bears today. They've been bears since 2016. You know what I mean? They probably been, actually a lot of like quote unquote experts probably been bearish since 2013, 14, and 15, right? And I think, there was a lot of complacency. I think what happened was, we saw that pretty steep, like 10-12% correction there. And we talked about this already, and just recapping everything. And I think a lot of them kind of finally start turning bullish here. And then that's kind of what that was. And then finally, this pretty much shocked the world, right? And it's like, okay, now we saw this 20% decline, very, very fast decline. And people are comparing this to 1987 Black Monday. They're literally comparing this move to 1987 Black Monday, where there's going to be another 20-30% coming. And then a lot of people are saying, okay, this thing came down 20%. Well, where is the double bottom? So a lot of people are waiting for double bottom, right? Because, I mean, you see 20% correction. There's no way we're going to see a V-shaped reversal. Because, I mean, nowadays people have all these stats, right? They pull out all these stats. When this happened, what's the percentage of this? What's the percentage of that, right? We've never seen a V-shaped reversal ever after 20% correction. When you see a 20% on S&P, you usually see double bottom, or maybe inverted head and shoulders. Inverted head and shoulder meaning this thing making actually another low, right? And then doing that. Or maybe some kind of a consolidation, right? Basing out period before moving higher. And that's what everybody was thinking. And so what does the market do? Market gives you the V shape, which nobody was anticipating. And then when this thing gets up to 280, right? What does the people do? Well, people finally thinking that, well, maybe this bull market will continue higher. So expecting, because think about it, if you close out your positions down here with loss, you ain't gonna go back full on bullish with like measly 3% correction, right? What was that? Like 3% correction. You ain't gonna go back long now. I mean, we saw 20% decline. You're not gonna go back long now after 3%. Hell no, right? So then we saw 3%. Many were expecting a much, much bigger pullback to maybe 260s, maybe even beyond. Maybe even I remember people are still saying this thing is still going to retest the lows, right? Still going to retest the lows. Well, that wasn't going to happen, obviously, and which I've been talking about throughout this year. And we didn't even get to see proper invert head and shoulder, which everybody was waiting for, right? And then this thing continues to move higher. It's because there are many people are still left behind. And when that complacency is at a max level, when the bears and the cash people, they start jumping in because they can't wait any longer. It feels like this market is never, ever going to pull back. When the majority of market participants jump back in fear of missing out, that's when you're going to see this market pulling back. So where is that level? Well, nobody really knows. I think around 300. I mean, I've been targeting 300 since the December lows, right? You guys remember that? But it can't be 300. Maybe it's 295. It may be 310, 320. I don't know. I mean, we've created this monster. You guys understand this? We've created this with all these people in different parts of the world trading this market, investing this market with all of their greed and fear and their cultural values, belief system, differences that we have, just how the human psychology work and all that putting together. We've created this monster, right? And when market knows there's a majority of participants getting back in and the complacency, it is at its max, at a max level, meaning they're like, oh my God, this thing is probably never going to see us pull back. We're probably going to continue to go like this for an entire year. That's when we're probably going to see, I'm guessing about 5 to 8% corrections. About 5 to 8%. But I don't know where that level is, guys. Nobody does. I don't know where the level is. I think 300. I think we're getting there. We are stretched. When it comes to statistical probability, what I mean by statistical probability is, I mean, looking at past historical, how the market performed after market moved certain percentage. That's what I mean. Statistical probability suggests that we are overbought and we are due, quote unquote, due for a correction, meaning market doesn't have to correct. Market could very well continue to move higher, but odds are catching up against the bulls, right? So In one hand, you're like, okay, well, the market is extended here, and there's no way nobody's gonna go full on bullish at these levels, right? If you know what I mean? Unless you've been holding full throughout this move, you actually bought more at these lows, you ain't gonna start going full on bullish here after 25% run. No, in 3-4 months, 20-25% run, you're gonna go full on bullish here? No, there's no way you're gonna do that. So everybody's looking for, everybody's waiting for, everybody's anticipating a sharp decline. And they've been waiting for 3-4 months already. So they're getting tired. But they're gonna be like, be patient, right? And sooner or later, that patience is gonna break. And they can't wait any longer. Bears can't wait any longer. They then sick and tired of losing. So they start going long. The sideline cash people start going back long. The bears start flipping bullish. That's when we're going to see a steep decline. But that level, only market knows. Market is only going to know where that max complacency level is going to be. So we want to continue to give benefit of the doubt to the buyers. And I've been trimming my aggressive positions. When I say aggressive, I mean call positions. I've been trimming my call positions, but I'm holding full my long-term investing position, and those are shares. Those are shares on the individual equities. But on my call options, I've been trimming those throughout this recent run-up here. So, but when it comes to this level here, 300, I think that's the level we may see resistance here and maybe pull back. But I'm not sure even if it comes to 300 at this point, we maybe need more data. I'm not sure if it's going to go up and then pull back maybe 2-3% before going higher, or we're going to see much, much steeper. Let's say we go to 300, like about here, right? 300. And then if we pull back 3% will be 289. If we pull back 5%, that will be 284. If we pull back, let's say 8%, that will be about 275, right? 275 or so, right? That's kind of where this level is at. You know, the worst case scenario maybe 8.5, maybe about 273, 270 at worst. If we do see a pullback, I think the worst case scenario, we go to about 270 at worst. That's the worst max level. We go to 270, you buy that dip. But again, it's not going to be that easy, guys. Market is not going to make it that easy. And you say to yourself now, okay, when we see 5, 6, 7% pullback, I'm going to buy that dip. You know what? When that actually happens, you probably going to get scared. And you probably not even going to buy that dip. And then you're just sit there and watch. Well, okay, it looks like it's could maybe crashing, you know. It looks like there's a gigantic triple top, K. And then when we see 8%, you're scared and everything looks bearish now. And you're hesitant to buy that dip. And then market is going to do something, turn things around. All of a sudden, boom, bam, we're 320. And you miss that opportunity. And that market is master at that, right? That's why all these stupid gurus and these stupid people on Twitter that you follow, they're like, oh, look at this setup. Oh my God. You know what I'm saying? Like they have no idea what they're doing. You just think that just because you drew a couple stupid lines, you really think like, you know, somehow that's going to be like, you know what I mean? Market is going to demolish you, right? You just because you knew, you know, you just threw a couple lines, you're going to trade off of that and, oh, I'm going to go along right here. I'm going to place my stuff right there. You do that, you lose all your money. It's more than that. It is more than just drawing a couple lines. You see what I'm saying? You really have to start thinking different. You know, you start listening to CNBC, what everybody's listening to. You start following these people, what everybody's following. You start reading the same thing, what everyone's reading. You start looking at the same levels, what everyone's looking at. You know what I mean? Then you're gonna be losers like everybody else. Because 90% of market participants, retail traders, they lose. If you want to be wrong, then follow the masses. So anyway, that's my take on the market at this point. It's all these moves mostly purely psychological. Mostly purely psychological. Everybody's dumbfounded, everybody's shocked, everybody didn't anticipate it. That's what is happening. And I don't know how long it's going to go on. If it continues to go on throughout the rest of this year, that's great because I have so many longs I've been accumulating since early 2016. But as the market continues growing higher, what do you think I'm going to be doing? I'm going to be trimming. I'm going to be closing out my aggressive positions. I'm going to be trimming my call positions, closing out my call positions, and hold my long-term position. Because my long-term shares, I'm going to be holding for 2, 3, 5 years. So if we see a steep pullback, I'm just buying more shares. So that's the strategy for me at this point. So I think with this evening start kind of forming here, it's not confirmed yet, but I don't like to really put too much emphasis on the short-term patterns. But this 3-day pattern potentially as short-term reversal pattern that could potentially push this to 300. And we'll see what happens next week. This is the current resistance at 294, and we'll follow up on it next Friday. All right, let's go to diamond here real quick. I'm gonna do a little bit of maintenance here on this. I haven't changed anything on this chart. Let's get rid of those. And how I want to do this is I want to pattern it like this, like that, and I want to make it look like kind of a rising wedge, right? What does your stupid cheat sheet say about rising wedge? Well, the rising wedge, it's a bearish signal, okay? That's what my cheat sheet says. And this guy who has 100,000 followers, he tweeted out and he said I should print it and put it next to my trading desk. And that cheat sheet says that these rising wedge is a bearish signal, okay? You know what I want you to do? I want to take the cheat sheet. I want you to take it and burn it. And never ever look at it ever again, because it's the stupidest thing ever. So you got a little bit of gap here. Oops. Right there, right? So you got a little bit of gap. You got a lot of these gaps here, which is a good thing. Gaps are a good thing, right? And so we got this rising wedge, and it's more of a consolidation pattern. You want to continue to give benefit of doubt to the buyers, and never ever trying to trade off of these patterns because you think this is like, if this thing breaking lower, you think that's like bearish breakdown. No, it's going to come down and take your stop or whatever, and it's going to go right back up, and you're going to try to play this thing breaking out. You're going to go along right there. It's going to come right back down. So don't ever try to play these especially short-term consolidation patterns. They a lot of times sometimes it breaks out flawlessly, breaks out and it just goes perfectly, but how many times does it do that? It doesn't do it quite often. But this is not really like trade setup for you to trade. This is for you to just kind of understand what the price is doing. We had pretty much V-shaped high. It just went straight up, right? And now we're kind of consolidating. Now we're tightening up. Can you blame Dow Jones tightening up a little bit after this kind of? No. And this is actually, as far as the intermediate term trend is concerned, this is a healthy thing. Even if this thing breaks lower, it's still a healthy thing, right? Because we didn't see this thing going right back up, coming right back down. That's what you don't want to see. Because sometimes it does happen when the market goes, a lot of times it happens a lot in an individual equities, where in companies what it does is it goes straight up and then comes straight down. That's not healthy. But hey, this thing went straight up and then we're consolidating, floating up. That's healthy. That's what I want you to see. That's healthy. You see what I'm saying? We're staying above the 20 EMA. We got these gap ups here, and see if we can break out of that. We still have all-time high level at 270 or so, 269. Qs is well above all-time high, right? We came and perfectly retested this. And then we bounced right off it. We got another gap up here. Another gap up. And don't be telling me that that's exhaustion gap, because I know anybody who's saying that this is an exhaustion gap, they've been saying it maybe here. That's an exhaustion gap. Oh, 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 this has to be an exhaustion gap. So they've been saying it for months. So don't tell me this is an exhaustion gap, because it's not an exhaustion gap. We don't know it's an exhaustion gap until we see this thing start falling back down, But we don't see that. We're at 20 EMA, continue to hold. We retested prior resistance, new support. It's when it comes to short-term perspective, right? And NASDAQ is up 22% year to date. It's up since the December lows. It's up 33%. And the majority of participants is not participating on this. And as long as that stays that way, the market is going to continue to move higher. And it's going to move higher and higher and higher. And when most people say it cannot possibly go any higher, it's impossible. Impossibility is going to become possibility. And it's going to continue to move higher. And it's just going to irritate so many people. And then when those irritated people finally decided they want to jump in, that's when the market is going to pull back. So at this point, you want to give benefit of doubt to the buyers that this could very well continue higher. But at the same time, see, the market is never black and white, guys, just like life. Same time, know that back of your head, we are extended. We are quote unquote due for a pullback, but we may not get it. And nobody knows when we're going to get it. Again, when the complacency is at its max level, and only market knows that, when the max level is going to be, that's when the market is going to pull back. When you start hearing the traders start saying stuff like, this market is never going to pull back. This market is never going to pull back. And when majority of traders start feeling that way, that's when you're going to see some steep, sharp pullback coming in. Again, 5 to 8, 5 to 8. But it's not just going to be normal 5 to 8. It's going to do something. It's going to shake your core. And when you're trying to buy that dip, when it does have 5 to 10% or 5 to 8%, you're going to be scared. That's the 5-8% you're going to get. You're going to say now, you're going to tell me, Kay, when it sees a pullback, I'm buying because you're bullish. Long term, so I'm going to buy. But when you see that pullback coming, you're going to be scared and you won't be buying. So you must be prepared. You must be prepared. Let's go to Russell 2000. Broke out, right? And last week I told you guys that I won't be surprised to see this thing maybe coming lower, making new lows for a while higher, right? I talked about that, and I talked about how I won't be surprised to see something like that. But looks at the market. I mean, there's still so much complacency. There's still so much scare that. Because I remember a lot of people are saying something like, well, Russell 2000, look at that. It's so weak. Well, because of that, well, it's a short setup or something like that. And Russell 2000, and the market knows it. The small caps market knows it. Most people are still scared. And then continue higher. But keep that in mind. We saw this move. Again, if this thing goes straight up and comes straight down, that's bad. But we consolidate. We throw some kind of a bull flagging pattern, and then we start kind of floating up. That's good. That's good, right? Even if this thing fails, come back down, the longer it floats around, it's better for the bulls. After this bullish move, you just don't want to see this thing, giving back most of it. We want to see this thing floating around, and that's how the bulls work. They like floating things around. And this is why bears are so freaking... Most bears... This is the reason why most bears are bears. Because they feel like, it take months for the bulls to make something work. And then it feels like one day, one bearish move can eradicate like months of move. This is a reason why most people think that bears are always winning. And they're always scared. Because you go long, right? And you're like, it takes days and weeks and months for this, for you to see your long positions possibly making its run, right? And then one day this thing just does full-on bearish, like this long bearish candle, right? Everything gets eradicated, right? And you feel like, and that's what most people are scared of. That's what most people are scared of, because they don't want to go long here because, well, it's been really not been moving up. It's been really grinding. So they feel like, okay, if I go long now, and then like one day we get like this gap down and a 2-3% flush, I'm done, right? Because you were scared down here, so you start trying to buy long there. That's why this is the dilemma that you have. That's why the dilemma here. Obviously, why the hell anybody want to start going full on bullish up here? No, because they're scared that sooner or later you're gonna see that steep decline. Like again, when that happens, most people will be scared to buy that dip. Market is not gonna make it easy for you to just buy that unless you're prepared. So Russell 2000 broke out here with the gap. You know what I want to do is I actually want to do this, just to annotate that gap area, that 158, 157. We stay above that area. I think we could. There's a little tiny gap here and here. I think this thing going to about 164-ish, as long as we can have to keep this gap open, at least stay above 157, because I think this gap will be crucial, and that Marubozu candle. So I think you can keep those gains alive, right? Maybe stay above 157. There's a good chance this thing going up here about 165. For sure, feel that tiny gap there. So I think Russell is going to lead. Russell and the banks is going to lead. Semis still staying up. Still staying up, right? A lot of people are scared the semi is going to crash the market. Look at that. This thing did the best out of all other indices. It was up 50% in 3 months. 50. 50. Let's go to the banks. Banks doing well. Really well. Really well, right? So you can see that, you know what I'm going to do? I'm going to do something like this. So we'll kind of clear that as well. But I don't want to put that there. I want to really emphasize this level, 28.97, because I have to still look at this as lower highs. You see, those are lower highs. And this is in the intermediate term. It's kind of a higher high there, right? But looking more of an intermediate to primary term is still in the vicinity of lower high. So what it really needs to do to change this thing around to make this in a primary term uptrend, go up here, make equal highs, pull back, and then get back up. I think time frame maybe works. I think if you track XLF, if you track the banks, maybe you can time the overall market where this thing continues to go higher somewhere in that vicinity. It might not be exactly at 28. It might be 28.70 or 28.60. I'm not sure. Maybe it might be 29.30, 40. I'm talking around that area, the vicinity. And then at some point, this thing pulls back, and at the same time, the indices start pulling back, right? Like something like that. And then finally, this thing gets up. And you know what I mean? And then we start cultivating higher lows. And I think when the banks are ready to pull back, maybe that's when the overall indices as well, like spider diamond Qs, start to see maybe steeper pullback. So I think I've been kind of tracking the banks here. I think maybe banks and the Russell might be the key. I think the banks and the Russell and the small caps and the banks, I think they are going to prop up the market. Remember what I've been saying last weeks and months is that these lagging sectors are going to, what is the catalyst? Market, we talked about this, right? Was it several weeks ago, a month ago? The market is up a lot already, 20-25% on the S&P and Dow and the Qs. What will be the catalyst for the market to continue higher? Well, these lagging sectors, the Russell 2000 and the banks, hasn't moved. I think they're going to start to move, like the money rotation is going to occur, and then that's what is going to prop up the market, and that's what has been happening. So now the banks are going up here to reclaim this level, and this is a crucial lower high. That's a crucial lower high. And then we start falling back from that level. We may not, though. It may not be especially like right at this level, around this vicinity. It might even go to 29.40, or it might come short at 20.63, right? So watch that. And then when the banks start wanting to pull back, to kind of cultivate the higher low, maybe then the indices start pulling back. But another scenario might be the banks might continue higher, pull back a little bit, and then go to all-time high too. That might be the case as well. So we'll kind of follow up on these levels next week, and we'll go from there, right? Well, you guys have a wonderful weekend, and good luck trading this coming week.